Hello everyone, welcome to Oliveboard. My name is Dinkar and I welcome you all in this session. I hope everybody is doing great, feeling healthy and fine. Once again, welcome to our Learn 5 Concept per Week series. So as you all know that we have already done 3 videos on this and we have got a huge response from all of you that you are liking the series. So we are continuing with this series. So again, we have today is Monday, and again we have come up with a 5 more important concepts. Normally, these are not different things; they are all related concepts. But most of the people have a kind of a confusion in all these things. So that is why I wanted to clear it off the confusion today. So we will be doing today that 5 important things that we are going to discuss today. So if anybody is there in the session, they can just tell me they can hear me properly or everything is fine. Is everything fine? They can just say tell me. They can just say hi, hello, or any thumbs up sign or anything they can give. So we can just start off with our session right away. So today's session is going to be really very precise, very small, but with a lot of information and a lot of conceptual clarity that you will be getting today. So once again, welcome to the session. Okay, so this is RBI Grade B 2023 classes, basic concept understanding, 5 important concepts. So we are pledging for a success with commitment, consistency, and after that we will celebrate. Today, the section that we are going to cover is derivatives. Okay, as the word you see the derivative, the word derivative itself says that you are deriving something from the other thing, right? Okay, derivative means that only thing. Okay, so let's see what is the actual meaning of the derivative. So derivative is something like from which you are deriving the value of something. Like maybe it can be a stock, it can be bond, it can be commodity, it can be currency, it can be interest rate, or it can be market indices. So anything can be a underlying thing. Okay, you say that I have 1,000 shares. Okay, but actually you are not buying that 1,000 shares. You are just saying that I have 1,000 share and this is the underlying commodity. If I say I have 100 sacks of wheat, 100 packets of wheat. Okay, so this is called underlying commodity. This is called underlying commodity. So this underlying commodity will be dealing in the form of a papers. Okay, there will be one paper that will be issued and that paper says that this paper amounts to all these things. Okay, so derivative, now we are going to study the important definition what the derivative is all about. Okay, so first of all, why we are discussing this topic, that we should know properly. As you all know that financial market are very volatile. All of a sudden things goes up, all of a sudden the things goes down, and people may loses huge amount of money, maybe sometimes people earns a huge amount of money. So there is too much of fluctuation that keeps on happening in the financial market. Okay, if we say foreign currencies, okay, foreign currencies, petroleum, other commodities or anything, okay, so they keep on fluctuating and there is a huge kind of risk that is associated because of this price, right? Because of this fluctuating price that is going on. Okay, so to reduce this risk, modern finance provide various type of instrument. Okay, it's like a hedging. One thing is called hedging. Okay, so derivatives are the things which are widely used for hedging purpose. That means we wanted to reduce our risk. What we wanted to do, we wanted to reduce our risk. Okay, we wanted to reduce our risk. That is why we wanted to use this derivative. Okay, so derivatives are product whose value is derived from one or more basic variable that we call it as underlying asset. Underlying asset can be anything. Okay, packets of wheat, then petroleum, okay, or etc. Many things, anything can be put as an underlying asset that can be termed as a base. Okay, so derivatives are financial securities such as options or future whose value is derived in a part of a value and characteristics of another as an underlying asset. That means if you say here, if you wanted to buy this uh, petroleum product, okay, you think that this petroleum price may go up because there is an issue of Russia Ukraine war. You think that the prices may go up. So what you will do is you will do a contract. You will do a contract with a petroleum company and you will say that I will buy a barrel, one barrel, one barrel at $40. So you have made a contract with a petroleum company that I will buy a barrel at 40. So petroleum company is also satisfied that okay, fine, no problem. I will do a contract with you. That means if the petroleum price goes any high, anything like if it goes $80 or if it goes $60, still I will only be getting at $40. So that means here I have reduced my financial risk. Okay, here I am able to reduce my financial risk because I have already done a contract. Okay, so you can call this as a future or a forward. Okay, that is used as a derivative. Okay, so the primary objective of any investor are to bring an element of certainty, because here I wanted to be certain, like I wanted to get the crude oil at $40 because I have to prepare a product from that. Okay, so because in order to minimize my risk of a future too much of price fluctuation, so I came in contract with a petroleum company, which I have asked them like we will do a contract that okay, the petroleum company is also happy and I also happy because both have their risk minimized. Okay, so derivatives are contract that originated from the need to limit the risk. So we wanted to limit the risk. That's why. So why I am talking about this limit risk, because if you go to share market, if you go to share market, so all of a sudden the share market goes up, all of a sudden sometimes it goes down. So here you cannot limit your risk. Here the thing is that you are getting something or you're losing something. Okay, so here you cannot say that okay, I have done this contract, even the share price goes below even the share price goes below 40, I will be still getting 60. No, it is not like that. In the share prices you get only the market value, right? So derivatives are mainly to utilize for the to limit the risk. Okay, so a derivative can include a debt instrument. You can have a bond paper, you can have a bond paper, you can have a shares also, you can have a loans also. Okay, secured or unsecured, you can have a risk instrument or contract. Okay, any price indexes or anything. Okay, so right now I'm moving towards some of the more conceptual clarity towards. Okay, so first of all, who are the people, who are the participants, like who normally works in this derivative market? So normally, like any other market, there are various type of people who buy, some people sell, some people speculate. Okay, so there are three type of people who normally participate in the derivative market. One people are called hedgers, another people are called speculators, and third one is arbitrators. Okay, so now we will be discussing what are these hedgers, speculators and arbitrators all about. So hedgers are the people, these are the investor with a present or anticipated exposure to the underlying asset which is subject to the prices. Normally these are the people who wanted to reduce their price risk. Okay, okay, so they are generally a commercial. So normally the hedgers are the people who are either the producer of anything or who are the consumer of something. Like if I say like I am a like if I wanted to buy sugar cane. Okay, if I wanted to buy a sugar cane, okay, for making sugar. Okay, so I know that in the future sugarcane price may fluctuate. Okay, sugarcane price may fluctuate. So what I will do is I will try to fix the price. I will come and contract with someone that for every ton I will give you, like for every ton I will give you rupees 10,000. So now the person who is actually buying, the person who is actually buying the sugar cane has minimized his risk, because if the sugar cane price goes 12,000, still the person will be getting at 10,000 only, because already the contract has been signed. Okay, so the price risk has been minimized over here. Okay, so they participate in the market to manage their spot market price risk. These are the hedgers. Okay, so now the second people are speculators. Speculators are the people who thinks that the price of certain commodity will increase in the future. Okay, some people say that okay, this is some object. They say that right now the value is 100. Now for tomorrow the price of this commodity will be around 150. So these are the type of people who are speculators. Okay, so these are the trader who speculate on the direction of the futures price in the intention to make the money, because they believe that the prices will rise in the future. So they buy at 100 right now and they will sell tomorrow at 150, because they believe that. Okay, actually it is not happening, but they believe that. So for speculators, trading in the commodity future is an investment option. Okay, so maybe the price may increase, so they will have a profit. If the prices decreases, so nothing will happen. Okay, so most speculators do not prefer to make or accept deliveries of the actual commodities. Normally, here the actual commodity is not being traded. Like if I say sugarcane, so I am actually not taking the delivery of the sugarcane. Here, here the person will say, okay, this paper. I write a paper in which say this paper amounts to this much tons of sugarcane. So I buy this paper. I buy this paper at 100, and tomorrow I sell this paper for 150. I am not selling actually the sugarcane. I am only selling, I am just trading that paper in which it is written that this paper amounts to this much of sugar. Okay, so I hope you are getting it. Okay, so normally if the paper goes towards the expiry term, so the person has to take the delivery. But before the expiration of the date, before the expiry of the contract, they sell that paper, so that they just take the profit out of it. Okay, so they buy the paper at 100 and they sell for 150. So in between they made a 50 rupees profit. Okay, so actually the sugar cane has not moved, only the paper has moved. Okay, so actual commodity is not moving. Okay, so the at the last, so to whom the commodity will be having, the commodity will be taken by the person who was having that paper at the date of expiry. Okay, the person who is having that paper during that at the time of expiry date of that contract will be taking the delivery. Okay, now comes, so here hedgers way, what hedgers think, that hedgers think that we wanted to avoid risk, we wanted to protect against the future price change. Okay, so here the hedgers are simply the people who normally avoid the risk, so they come in contract beforehand. Okay, and they, because the main reason is that they wanted to make sure that they should uh, not go into that price risk scenario. They wanted to make sure that they remain safe during the price changes. Okay, and what about the speculators? What about the speculators? They take risk, because if I say today it is 100, I am expecting that it will go to 150. So here I am taking the risk. Here I am taking risk. I am taking the risk over here. Okay, so I am betting on a large profit over here. Okay, at the same time I may have a loss also. I can have profit also, I can have loss also. Anything can happen. So here I am taking the risk. I am taking the risk on both I can get profit also, I can get loss also. Okay. And I am taking the help of a price change. If the price changes in my direction, I am getting profit. If the price changes opposite in my direction, I am getting a loss. That means in the speculators, I am saying that 100 right now, I am expecting that it will go to 150. Okay, if it is moving in my direction, at least I am in the profit. Okay, if that price goes beyond that, I am in the loss. Okay, so this is the major thing regarding the hedgers and speculators. Okay, now the third category, the smartest one. The smartest one are the people. So first of all, let's have a differences between hedging and speculation. In the hedging, it is a strategy. It is a strategy to protect the investment from a adverse price movement, because here we are protecting ourselves from the price movement. Okay. In the speculation, here we are making profit by taking the risk in the risky assets. The hedging is main purpose is to reduce the risk. Speculation, the main thing is to make profit. Okay. How this work? Hedging works is protection from the future price movement. Okay. So we have to make sure that if too much of price fluctuation is happening, so we should come in contract beforehand. Okay. So in the speculation, they utilize this price movement for their profit. Okay. So how they operate? Risk averse investor opt for hedging if they wanted to reduce the risk, and the people who loves risk, they go for speculations. Okay. Volatility. Hedgers protect themselves from the price volatility. That's what they wanted to do, right? And what about the speculation? Speculator people use price volatility to make the profit. Okay. And profit potential, in the hedging, there is no or a very minimum profit. Okay. Because you are already in contract. So neither you can ask for a higher price, neither you can ask for the lower price. Okay. So whatever the price is there, you have to take it. Okay. But in the speculation, you can immediately get lots of profit, and you can get lot of loss potential also. If the prices goes in your direction, then you will get huge amount of profit. If the price goes not as per your expectation, you get huge losses. Okay. Now these are the two different things. Hedging people goes for the more protected way. Okay. Hedging people goes towards more protected way. In a speculation, people go for risky way. They can get huge profit or huge loss. But two things is possible, right? Now there comes the people who are the some of the smartest people. Normally, these are the called arbitrators. Who are these? So they are the people who buy something and sell the same thing, and they get the profit from the price differential. Like if I say, if I am A, if I take, here is a wheat. If I take wheat at rupees 40 per kg, okay, to the next place, I sell the same wheat at rupees 60 per kg to someone else, B. So, how much profit I am making? Rupees 20 per kg. So, here I am buying and selling at the same time, and what is the price differential, which it is going to be my profit. Okay. So, here it is like that. Difference between the future price and the spot price to make the guaranteed profit. Normally here you are getting a guaranteed profit. Okay. Arbitrators are the people who involve in simultaneously sale and purchase of the same commodity in different markets. Okay. You are buying from one market and you are selling in the other market, and the price differential between the two market you are taking as a profit. Usually what happens is that these are the transactions which are risk free. Okay, because you know that here the prices are less and here the prices are more. Okay, so from the less price area I buy the things, and where the prices are more I sell to that place, right? So this is how arbitrager works. So here we have a, like, if I say, like, market A, I take one paper from a market A for 100 rupees, but I know the value of the same paper in the market B is rupees 125. So I buy from the market A and I sell the same paper at 125 in the market B. So the price differential, that is 25 rupees, I will make profit. So this is how the arbitrators work. Okay, so here they are very sure of their profit. Otherwise, they will not put their money over here. Okay, until and unless they are sure of their money, they will never put their money over here. Okay, correct. Now comes the types of derivative instruments. Right now we are working right now we were talking only about what are the type of people who are there in the derivative market. Now, what type of instrument these people use? Okay, so normally the three main instrument these people use is forward derivative, future derivative, and options derivative. Forward, futures, and options, right? So first of all, what is meant by forward contract? So forward contract is a contract between two parties. Contract, party B and party A. Okay, party B and party A. Okay, a buyer and a seller. They will, one person will buy and this person will sell. Okay, like this. On a later date, that means they said that, okay, this B will said I will give you at rupees 10. The A will say, okay, I will buy it 10. Okay, B will say I will give this at 10, and A will say, okay, I will buy it 10. Okay, so here buyer has the obligation to buy. That means you cannot say no, you have to buy. And seller has the obligation to sell. Here seller cannot say I will not sell. Okay, both have obligation. One will sell and one will buy because you both are in contract. Okay, you both are in contract, right? So here is a short example of that forward contract, how it works. Okay, so there is a contract that has happened between a farmer and a customer. Customer can be any, like, you can call Ashirwad. Okay, okay, they're selling wheat only, right? Yeah. So there is an agreement that has happened between a farmer and a customer. What was that agreement? The main agreement is the farmer will sell 5 kg wheat at rupees 40 per kg after 3 months. Okay, the customer and farmer have a contract that after 3 months the farmer will give 5 kg of wheat to the customer at rupees 40 per kg. Okay, so 3 months later, what will happen? Farmer will give 5 kg wheat to the customer, and customer will give rupees 200 to the farmer. So this forward contract is fulfilled. Okay, so this is how we have pre-decided that what we will do. Okay, what we will do. This is called forward contract. We have beforehand only we have taken the position. Okay, because at that time farmer has not even sown his field. Still farmer has come in contract, because farmer is also of a view that maybe the monsoon was good or not, maybe I will get good surplus wheat or not. So farmer and customer both wanted to protect their money. Okay, so farmer said that, okay, 40 rupees kg, okay, I'm happy, customer is also happy with 40 rupees per kg. So okay, so both are happy and both will do their obligation proper, right? Now comes future contract. Future contract, it is also the same thing. Okay, a future contract is an agreement between two parties, buyer and seller. They will the buy one party will buy and the other party will sell on the future date. Okay, so but this contract is fulfilled on a future exchange. Okay, that is regulated exchange bodies. Okay, and everyday settlement keeps on happening over here. That is the main difference between the future contract and a forward contract. Okay, forward contracts are not settled in the exchanges. Okay, but future contracts settle in the exchanges. Okay, so what is the difference between forward and future contracts? Okay, forward contract nature is over the counter. Okay, future contract is done through a organized exchange. Like we have our stock exchanges are there, right? All these things are there. Okay, then what is the liquidity of that forward contract? It is less liquid. Future contracts are more liquid because you are working through an organized exchange. People can buy and sell over online and all these things. Okay, right? What is the contract item? Contract item is customized item. Customized item means you are the two parties are customizing. Like if I say in a forward contract, two A and B are there, I will say okay, 2 kg of wheat. Okay, happy. But in the future contract, there is a standard, industry standard is there. Like means if you are coming in any kind of future contract, at least you have to do a contract of 100 kg, at least. So there is a industry standard associated with it. Okay. So the forward contract is settled at the end of a period after the maturity is over, and future are settled daily settlement. Okay, so future is more organized, and forward contract is less organized. Okay, so in the forward contract there is a issue of counterparty risk. Maybe I say okay, I have done a contract but I will not buy. In the forward one, farmer will say but you have signed a contract, I will say I will not pay. Okay, so there is a chance of a counterparty risk, but in the future contract it is all done through a exchange, so you cannot do anything like that. Okay, so future contract are more customized, more safer than the forward contract. Okay, now comes our the other part of contract that are called options contract. Options, as the word suggests, here we are talking about the options. You have an option to do something. Okay, options to do. So options are of two types. One is call option and one is put option. What is the meaning of call option? Call option gives the buyer the right but not the obligation to buy. That means if I have a call option and I am a buyer of this. Okay. So and one person is seller. One person is seller. So if I wanted to utilize my call option, what I will do is that I can utilize that call option or I cannot, because since I have bought that call option, I may utilize that, I may not. Okay, but I don't have obligation. I can do anything with that. Okay. So if I say, I'll give you an example. And put option is gives the buyer the right but not the obligation to sell. Okay, here the buyer has the right but not the obligation to sell of an underlying asset. Okay, so how all these things work? Now, now I will give you one example. So normally the options work as a speculated market, speculation. Like it's just like you are betting on something. Options market normally works like a betting on something. Okay, so how you are going to do that kind of thing? So first of all we'll do a call option example. So one stock is there who is trading at rupees 50. The stock is trading at 50, and i think I think that the stock prices will touch rupees 60. That I think. Okay, so what I will do is that I will buy a call option. What I will do? I will buy a call option. Now comes to know what is the meaning of call option. Here in the call option, you don't have to pay full amount. It is just like you are taking a insurance by paying something a premium. Okay, it is not like that. If you are like if I say rupees 50 right now and I wanted to buy 100 shares, so I have to pay 5,000 rupees. No, I don't have to do that 5,000 rupees. Okay, I will say for this 100 share I buy a call option. Call option doesn't mean that I have to pay rupees 5,000. No, I have to pay only a premium, option premium. Option premium can be, you can pay like 1% of it. Okay, 1% of it or whatever it is. Okay, so if I say okay, option premium is like I have to pay for 5,000 I will pay like 500 rupees. Okay, so I have to pay only 500 rupees and this 100 share will be logged for me. What will happen? These 100 share will be logged for me for just paying rupees 500. But this call option has a maturity date. That means 15 days, 7 days, or whatever it is. Okay, 5 days, 7 days, or whatever it is. Okay, so what if share goes to 60? If the share goes to 60, okay, sorry, uh, I just wanted to explain one more thing. Okay, so I have buy a call option at rupees 55. That means I wanted to book my position at 55. I am right now the stock is at 50 and I have taken a call option at rupees 55. That means till 55 nothing will happen. If the stock price goes above 50, then I will get a profit. So if the share goes up to 60, so 60 minus 55. So for every share I will get rupees 5. For every share I will get rupees 5. Okay, like that. So I will exercise my call option. I will exercise my call option. Okay, I will get rupees 5 profit. Even I have not paid the full amount, I have just paid the premium out of it. Still I am getting a profit of rupees 5 every share. Okay, so and the person who has sold me this share is obligated to sell or the to me profit to me, because the share has gone above 55. So how much above 55 has gone and how much share I've taken? So just the difference of the value multiplied by the share I am having. So here I have utilized my call option. But now the scenario comes, I have taken a call option at 55. But if the share price do not go above 55, it remains at 55. If the share prices remain at 55, I cannot exercise it, because after, if the share price crosses 55, then only I will get the profit. So nothing will happen. But if the share prices goes below 50, below 50, so obviously I will not utilize my call option, right? So I will only lose my 500 rupees. I will only lose my 500 rupees and not that 5,000 rupees. Okay, I will only lose my 500 rupees. It is just like a insurance premium. It is just like you have taken, like you are saying that uh, you have a value of 1 crore. You as a human being has a value of 1 crore. Okay, but you will not pay that to insurance company, right? You never pay that 1 crore rupees to insurance company. You only pay the premium, right? Insurance company will say, okay, for 1 crore insurance I will take 1% premium. Okay, with 1% premium you are get insured for 1 year. Okay, if anything happens to you, that 1 crore will be yours. And if that in 1 year nothing happens to you, only that premium goes to the insurance company, you will not get the premium back. Okay, so in here, if you do not get, like if the share market not goes above 60, so you will not get this 500 rupees back. Okay, so it is just like that. You are buying a huge lot of thing at a very premium, and you are playing on a value. Now, put option. So here, if I say, if I have a stock at rupees 50, and I think the stock will go to rupees 40. So here I am speculating that the prices of the stock will go down. Okay, so I buy, I buy a put option. I buy a put option at rupees 45. I buy a put option at 45, right? So, and for this rupees 45, I don't have to pay the full amount of the lot. I will pay only the option premium. I will pay only option premium. That is the premium. Okay, so like the way you pay for insurance, right? You do not, like when you have, if you have a 100 crore, sorry, if you have a 1 crore of insurance, you do not pay that 1 crore rupees to the insurance company, right? You pay only the premium, and with that you became secured, right? So that is here only in the option, like either in the call option or in the put option, the similar things have worked. Okay, here you pay the option premium, and you buy that thing for certain. That means you take that thing for a certain time period, or till maturity. Okay, so options normally have a maturity of 10 days, 15 days, or they can have a 1 day also, or anything like that. Okay, so even so even if the stock goes down below 40, still I can sell at rupees 45, because I have buyed a put option at 45. I have buyed a put option at 45. Here, seller is obligated to sell at 45. Okay, but if price of put option does not go below 45, so your put option became useless, because you cannot utilize the price differential, because you have bought the put option at 45 and the price still remain at 45, so you cannot utilize, okay, that option, and your put option became useless. Okay, so in that case, what you have lost, you do not have lost your money, you have lost only the premium that you have given. What you have lost, only premium what you have given, like if 1 rupee you have given as a premium, okay, that only you have lost. You have not lost the whole value of that shares. Okay, so that is the call option and put option working. Okay, so in the call option, normally they take the thing that they speculate that the prices will increase. Okay, so after certain limit, if the prices goes above that limit, so they get that much of amount. Okay, if they put a put option, if the prices goes down, then if the prices goes below that level, so they start getting the profit out of it. Okay, so this is how the put option works. It is not here it works like a insurance. Here it works like a insurance. I buy a insurance. I i buy a insurance. If I say, okay, I buy this 1 crore insurance for rupees 1,000 rupees, 1,000 rupees. So for one year life, I got secured. So similarly, in the put option and call option also, the same things work. Okay, here you only pay the premium amount. Okay, and how you can get the profit in that call option and put option? By speculating the price, and if it goes below that, and if sometimes it goes above that, you get the profit out of it. Okay, so this is how the put option works. Okay, so guys, in the call option we have a right to buy, in the put option we have a right to sell, right? So these are the differences. Buyers, those who are having a call option, that if some buyer is having a call option, that buyer has a right to buy but not obligation. When the put option, buyer has a put option, they have a right to sell but not the obligation. Seller obligated to sell, seller obligated to buy. Okay, call option value increases, the underlying asset increases. Put value decreases of the underlying if the underlying asset value increases. Okay, here investor of the call option looks for price rise. More the prices, more the differential they will get. Put option, investor are looking for the fall in the prices. Okay, so here in the call option, the potential gain is unlimited. In the put option, the potential gain is limited. So these are the derivatives of call option and put option. So guys, we are running our Nabard Grade 2020 classes. We have already started from 4th of July. 50 classes are there and we have already completed few of the classes. So total 50 plus classes you will be getting for ESIRD, current affair, descriptive answer, descriptive English and everything. So please join our Nabard Grade A classes because the exam dates are already out and you have to be on your toes for the preparation and we are here to provide you all the necessary support. And guys, today is a very important day because today we are starting our RBI Grade B 2023 exam. Build your basic classes. This is a foundation course. Live classes will be there, and here we for your benefit we are providing few free live classes, so you can join our free live classes. Check the quality, check the content and feel the difference. Okay, so from today at 9 p.m. it is starting right now. After 4 or 5 minutes the class will start, so please join us and feel the difference in the class. Okay guys, so thank you so much guys. Bye bye, take care and good night. I'll see you at 9 p.m. now. Thank you.